It's Brian Preston, the money guy.
So I think it's rich because Vanguard made their money, meaning, well, they made their market share. They have become one of the most predominant investment companies in the world because Jack Bogle understood how it's just better to buy the index funds. Keep the costs low. There's a lot of good things that happen by buying index funds. So it's surprising to me that Vanguard has gotten into the market prediction game.
Yep.
And so let's see how well they're doing.
So let's look at some recent headlines that we were able to pull. This one is from CNBC. This says, Vanguard Group outlook for stock market returns reaches a post-financial crisis
That's
low.
2017, because we're going to do this in chronological order. So you're going to notice in 2017, they're saying, I don't know about this. Outlook is a little gloomy.
The next, Vanguard, you'll make a lot less money in the stock market in the next 10 years. Here's what you can do. So now they're telling you how to avoid making a lot less money in the stock market.
July 2018, still pretty gloomy. They're telling you go make a lot less.
But both those are CNBC, so let's look at a different source. The New York Times said, Vanguard warns of worsening odds for the economy and the markets.
Man, this is not looking good. They're predicting that things are going to be pretty tough.
Motley Fool said, has Vanguard been seduced by the dark side?
So, and then you'd think, okay, they stopped. So 2018, we did have fourth quarter where it was pretty rough. So we'll give them some credo that the market was bad in 2018. How about 2019?
In 2019, again, Vanguard dramatically cuts its expected rate of return for the stock market over the next decade.
Bo, isn't 2019 the stock market up almost 30%?
It has been quite a positive year for investors this year.
So if you're going to start predicting that the sky is falling for investors, that you need a low, let me give you some quotes. So let me just read this to you. I got two quotes from that one of those CNBC articles from back from July of 2018. It says the economists at investing giant Vanguard predict that over the next 10 years, annual U.S. stock market returns will likely average between 3% and 5%. When you factor in inflation, which luckily Vanguard predicts will be below 2%, the real rate of return is expected to be under 3%. That's not it, because there's more. There's Jonathan Lemko, who is Vanguard's senior investment strategist. He continued, he said, we do expect for the foreseeable future far more modest returns than we've seen in the past few years. Not terrible, probably not negative, but much more modest, positive returns.
Now, both of these predictions were like looking out 10 years. So there's a chance they could still be right. But if you would have acted upon these actions based on just those narratives alone, you might very well have missed the year that 2019 has shaped up to be.
2019 is going to be one of those sweetener years that gooses. I mean, it juices your performance return for the next decade.
Yep.
So I'm just telling you, if you go back to the founding of Vanguard, Jack Bogle, I don't think would love that they are now in the prediction game because they are just as bad as everybody else in the investment marketplace.
It's so funny you say everybody else, Brian, because what we wanted to share is that, we've picked on Vanguard a little bit here, but it's not just Vanguard.
No, it's not. I wanted to highlight the
whole
irony of Vanguard getting into this because they know what made them successful. You always see this about companies. You say, do you know what your why is and what made you successful? And then to see them kind of go 180 degrees and try to get into the prediction game like the rest of the market, who's horrible at it, is done, is incredible. But it's not just Vanguard. Let's pick on the media a little bit, too.
And it's not even just a new thing. So we say the Vanguard's kind of got it. Look at this. We went and pulled a few headlines. In August of 1979, this is a super famous magazine cover from Business Week, The Death of Equities.
The death of equities.
Investing
that means
in
they're
equities,
done.
They're
Gone.
done. They're just not going to work anymore. Well, if you look at what the S&P 500 did over the next 12 years, it was quite a different story. For those of you out there listening in iTunes world, what you can see is that the S&P 500, this has at base level at 100 at the beginning of 1979.
You'd have missed a four-fold increase
That's exactly
if you'd have listened to Business Week in 1979 because the market quadrupled in that period of 12 years.
Yep. So, the media doesn't get it right when the things are bad. Well, maybe they get it right when things are really, really good. So let's look at this money cover from March of 2000 where you could learn
how to invest in the hottest market ever.
Now is the time to get in because this thing is rock and roll. Well, if you just looked at what the S&P 500 did over the next 2.5 years, not quite so good from March of 2000 down through September of 2002.
I'm starting to notice a trend here is that when the press is getting excited or they're very scared, you should probably think the opposite.
Yep.
Be that contrarian mindset.
So, okay, now let's look at another one, more recent memory that we can all kind of think about. In October of 2008, there was a time cover, and it said the new hard times. And if you can't see this on the screen right now, what it actually shows is a soup kitchen line. Folks lined up. Now, I remember 2008, Brian. We were doing, it was scary, but there weren't, it wasn't soup kitchen lines. That's not what was going on in 2008. So when we look at it, what actually happened over the next 11 years?
Look at that. That is incredible. Once again, so if you thought that quadrupling earlier was impossible to repeat that process again, the same thing has happened in the fact that $1,000 invested in 2008 is worth well over $3,000 right now. So we have tripled. The market has tripled since this cover came out in October of 2008. And I want you to think about that. If you're a person reading this, you're seeing a picture, the visual of a soup line from the Great Depression with the title, The New Hard Times. This is preparing, when you say the new hard times, this is saying we have a brand new, paramount of things are changed. You need to change the way you think about things. Whenever people tell you we have a new norm, guys, I want your spidey senses to be going off, because usually they're wrong.
That's exactly right.
There is something incredible about human nature and our desire to innovate and grow and be successful. So be very careful, because remember also, how does the news media get paid? They get paid by eyeballs and ears and getting attention by selling ads. So they got to scare you, because that keeps you tuned into them. But they are horrible barometers of what's actually going on.
Yeah, and you can see on this illustration that from 2008 through 2018, the market has just done really, really well. It's been a really positive decade. So I'm assuming, Brian, right, the news media figured that out, and they started telling you how good things were doing, how good things were doing, how good things were doing.
No.
Not the case.
So show them these headlines. This is incredible, because this title slide is, Can the Media Predict Recessions? Now, you guys know we've done other shows where we've talked about what you can actually expect with financial markets is that investing is like walking up a mountain with a yo-yo.
Yep.
Yes, in the short term, markets are going up and down. That's that yo-yo going up and down. But just like when you take a hike to climb a mountain, you keep going to higher and higher ground, and it's the same way with investing. So I want to just we put out, there's at least 6 or 7 quotes and headlines that Daniel found, but the first, I thought it was quite rich. It's somewhere between 2009 and 2010. The market's going up, but there's a headline that says, the risk of a double-dip recession. And then you fast forward, and there's another headline, and it talks about, and this is between 2010 and 2011, since it wasn't right then, they said, let's hit it again. So time to say it, double dip recession may be happening.
Yep.
And guess what? We're still going up. This is what's crazy, is that they have not, it's like a clock that's right twice a day.
Yep.
The batteries are dead, it hasn't been wound up, but they still keep banging the drum. And then it's one of those things when you look at the last part, and it says, and this is probably from, I'm looking at the blue there, Bo. That's probably also from like 2016.
Yeah.
Why America's big banks are predicting a recession.
Yep.
They should not be in the predicting recession business.
You said it so right, Brian. They keep ringing the bell, And look, here's the deal. Eventually, they will be right.
Yeah,
Eventually,
the market
we will
have a correction.
A pullback and a correction. What you have to figure out is, who are you going to listen to, and when are you going to listen to it? Because if you would have listened to any of these headlines in 2009, 2010, 2011, 2012, 2013, you would have missed a really, really powerful market that we've seen over the last decade.
So share with them, this is some money guy knowledge here. What's some words of wisdom that actually are much more powerful than the predictive power of the news media or Vanguard or anybody else?
Yeah, so one that we love, this is from Peter Lynch, and he was a fantastic money manager. He said, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. In other words, just trying to avoid it, trying not to participate in it, trying to time it, you've probably lost more money through opportunity cost than if you just would have weathered the storm and made it through.
And then there was one more quote, and this one's funny because we couldn't find who the author was, so we just assume all quotes that you can't find the author. Ben Franklin probably
of course.
said it.
Got to be Ben.
So what's this quote?
This quote from is time in the markets beats time-ing the markets. It's much more about being there and being present than trying to figure out when to get in, when to get out.